The new year is time of renewal, and for many businesses, a time to reevaluate and create goals for next year. This 2020 is very special. In this session, I'll go over year-end preparation for most businesses so that you will be able to jump into New Year strong and with a realistic objectives. This is the time we talk about things that very close to your wallet, things that very close to your bank account. And everything we talked about is to help you to generate wealth through pandemic and over the pandemic. And if you need to take a note because today there's a lot of information and anything that I went through a little bit broad or too general for you, that just means that you have a duty to drill it down to understand it. It is impossible to cover all the preparation we needed for the year end in one setting, but you can get the key point. You, as a business owner, you have no business to do anything in that great detail, but you have a business to understand everything I say today. Objective of this hour is to go over the year-end preparation for you, and at the same time, I will dive into your new year planning because some concept is so important. Before I talk about year-end planning, I want to give you a big picture. And we understand that. I know the election, the current Trump is not yet, uh, decided, and he will concede. So there is a little struggle over there at White House. But I just want to introduce to you of the possibility of the new tax plan, and not by every bullet points here. I am showing you this. I want you to just see one number. Didn't you see 400,000 all over the place here? And that means 400,000 is an important threshold. And when Biden becomes the president, when he can make the Senate and House pass the rule, and then he can sign it into law. And that's a process, right? And the fastest one in history takes 8 months. So he come in January, so it would come out maybe September, October if he's really efficient. If the two House and Senate cooperate, right? There's a lot of if there, but we just want to know that Biden's tax planning has two focus. On personal side, and he's focusing on the $400,000. 400,000 means if you're below, he doesn't. He said that he won't make much changes for you. But if you are over, he wants to charge more taxes. And while he said that, he also expended a lot of social welfare like kind of tax credit, like child tax credit, earned income tax credit. There's a lot of money are earmarked for people that who are in hardship. So, and that's a spirit of Biden. And on the next thing related to taxes on Spirit Biden is to increase the corporation taxes. Corporation taxes means the big companies. And right now, Trump lowered the C corporation taxes from 38% down to 21%. Okay. And here, and Biden said that maybe not. I want to raise it back to 28%. That has a huge implementation for medium-sized businesses. To the big-sized businesses, trust me, paying 21%, 28%, if it is someone are so grateful with the money they made, they don't care. They pay taxes. They want to pay taxes. If you don't make them pay taxes, they put in the foundation, they give out money to the nonprofit. So that really doesn't do a whole lot of good for people who are very wealthy. But the mid business, the business that ranging from profit from 200,000 to 5 million, those kind of the chunk of middle ones, those are the ones will have a lot of impact on there. A lot of our clients are in that range. So, actively, we are already watching and looking to see at what point of time those C corporations should be changing to something else because we don't want that to be 28%. Now, I will go through a series of things that before December 31st, you must do. Okay? So the number one is inventory count. And I know you're going to say, oh, wow, you don't need to say that. I already know. No, you don't know. And what happened is, please make a note. In 2020, And when you count inventory, you need to write off all the inventory that you could not sell. I know how we feel. We bought something and we want to resell. By the time the stuff came in and the trend of selling it is already gone. For example, one of my clients, and last year during Christmas time, they ordered a lot of new Christmas items, but for whatever reason, and because in December, I think there's the pandemics or something is already happened overseas. So there's delay in shipping. So a lot of those timely items actually came in January and February. So they keep it all the way to now, wanting to sell it. Pandemic is so deep and heavy here, and there is nobody really buying it. So you end up with inventory you cannot write off. You cannot sell. But what you can do is to write it off. And when I say write it off, means what? Means you are going to completely, on your accounting book, you're going to zero out the inventory that you cannot sell and is outdated and put them in cost of goods sold. And keep in mind, I always tell my people that I know inventory, cost of goods sold, and the tax, non-tax, tax more, tax less is so confusing. But you only need to remember one thing from me. The higher the inventory you have, the more inventory you see in your warehouse, the more taxes you pay. Don't ask me why. Just remember that's how it is. Okay? Because when I explain to you why, and it's becoming a education, it's becoming a accounting class, and you are entrepreneur. You don't need to be accountant. But I want you to know that the more inventory you see on your shelf, the more taxes you pay. So I want you to go to your shelf and then look at your inventory, decide, are they outdated? If the answer is yes, write them off to cost of goods sold. So they're done. They're zero. They're worth nothing. I don't care how much you bought for it. So you write them off. So inventory counting at the end of 2020 is so important. I want you to write off anything, everything you know need to be written off. Don't feel sorry about it. And write off doesn't mean you throw it in the trash can. Don't rent a dumpster and ready to dump everything, because you might still sell them. But when you sell them later, you have no more cost attached to it. So let's say if you have a bag of rice, it's outdated, so you are going to throw it away. You are not going to throw it away because you feel like, well, someone would get a discount. Buy my bag of rice. The bag of rice, let's say, is $10. You bought it. You are going to sell it for $20, right? So what you do is that you will write off the $10 you bought this bag of rice into cost of goods sold. I know you didn't sell it, so we write them off. But on the shelf, you still have this $10 bag of rice. If you have a customer came in and they said that I want to buy your outdated inventory like rice, and instead of selling me $10, can you sell me for $5? And you don't have to tell your customer, goes, oh yeah, I can sell you for $5. I wrote it off already. It has no value. You can tell the customer that I can sell you for $10. So you recover that $10. That $10 is 100% gross profit because you already wrote that off, right? So inventory write down doesn't mean you throw them in the dumpster. Inventory write down means later on, if you sell them, that is 100% gross profit. That's okay. And we can make money in the future, but I am talking about 2020. And the reason why I want you to write inventory off like that is because 2020 is special. 2020 is a COVID year, and we had CARES Act. CARES Act said if 2020 you have a big loss, say inventory you got 1 million, and you wrote them all off. So you only had a $200,000 sales, you write off $1 million inventory. Exaggerated example. I'm not saying that you're doing it, but I'm giving you exaggerated examples so that you can make a judgment, right? So you got $800,000 loss. Am I right? Because you sold for $200,000, you have $800,000 inventory write down, which is cost of goods sold. You have that $800. You have that $1 million cost of goods sold because the inventory is 1 million. So you put 1 million there. You have $200,000 sales. So you ended up with $800,000 loss. Okay, CARES Act and becoming a law on March 27th said that $800,000 loss you have, and then you can go back 5 years to look for the profit you paid taxes for. So you may have an $800,000 profit in 2018. You paid a lot of tax for it. And then now you can go back, offset 2018, get your taxes back. Do you know how fast you can get it back? IRS promised that to be in 90 days. 90 days, 3 months. Okay? So that is why inventory counting is so important. It has much deeper tax implementation this year than ever. And so in the past, we say inventory count, you want to be accurate. And if you are a business owner, just don't want to write it off, like to keep it in the inventory, nothing wrong with that. You don't have to write them off. But with this particular situation right now, writing off inventory is not against the law. Writing off inventory is a business judgment. And if your rice expired, you're supposed to write it off anyway. You really should not be keeping that on inventory when you sell and change the expiration date. No, right? So with that, and you know what to do as a business owner. So make sure you work on inventory. So important. I can't tell you how important that is. Okay. So number one, before December 31st, 2020. And if you don't know how to do it, you have a tons of questions, and we do provide business consultation service, and our staff can provide you tools to do that, and we can help you have that. Okay. Next one, you already you kind of see that I listed here. Donation has much greater purpose than ever, as this can help to utilize CARES Act benefit. So donations, okay? Every time people talk about donation, they think about the Schedule A donations. No, I'm not talking about that donation. Okay, this year with CARES Act, it has two things that I want you to know. If your corporation made money this year, let's say you made net profit of 100,000, and you can write off $25,000, 25% of your net profit, your taxable income. Okay, 25% of your taxable income can come out of your company, and it goes to a nonprofit organization of your choice. Well, you can come to Immigrant Entrepreneur Summit. That is a nonprofit community CPA put dollars to. That is a nonprofit. Wells Fargo put dollars in. And that is also a nonprofit. US Bank and many other companies are putting money in Immigrant Entrepreneur Summit. So you can choose one. You can do that one. And you also can form your own nonprofit. If you have a passion, there's no nonprofit out there can fulfill that for you. Why don't you do something? In 2008, that's what I did. In 2008, there was no nonprofit out there to support immigrant entrepreneurs. Those immigrant entrepreneurs, they don't even speak English properly, never mind about knowing rules and regulations. So they are a special group of people. There's nothing out there. So I and the two other business people, we formed a nonprofit. And so from there on, it's become something that I care. So almost like my kid, I need to make sure that it has the funding to run and it is going healthy. So you can start something like that too. And you ask me, how long does that take to start one? If you call us on Monday saying you want to get a nonprofit established, we'll get that in before December 31st. Then you can donate right away for 2020. That's how fast you can do it. Okay, so company donation. What about personal donation? 2020 CARES Act said you can donate 100% of your income and to write that off. So what does that mean? Let's say if I make salary of $20,000 a year, and my tax return has 20,000 AGI, I decided to donate all of my AGI to Immigrant Entrepreneur Summit. And you can do that. It allows no more ceilings. And in the past, you can donate all your income. Now you can. And so you will put that 20,000 into your Schedule A and do itemized deduction and wipe out all your income. And the taxes you paid on your W-2 come back as a refund. So on the personal donation side, you can do 100% your income donation. And you also have a $300 extra donation that you can put before Schedule A to lower your tax rate. So it's a small dollars. And I mean, if you come to do your taxes, we always make sure you have that in, but it's really not something earth shattering. But the company donation and writing off all your personal income into donation, that is a thing. And let me tell you what kind of people on my client list actually is doing that. We have a lady and who just sold her businesses in 2020. Actually, she planned to sell it even before the pandemic happened. So it was always in the plan, negotiation already in place. So pandemic didn't really change her mind. So she went ahead and sold it. And now she has a lot of income on her personal tax return as a result of selling the business. But she sold her business because she wants to do something more purposeful. So she formed a nonprofit, donate everything into the nonprofit. So now, does she have taxes to pay? No, because it's all went to nonprofit. So her personal taxes is zero. Nonprofit received the donation. Nonprofit is tax exempt, so no taxes. All right. So donation before December 31st, 2020, you have to do that. The reason I say that is our personal taxes are cash based. So that means if money didn't come out of your personal bank account, it doesn't count as donation. It has to be donated, done, done, done. So cannot be like you wrote a check, but you're just thinking and didn't give out. You can't count that. So that's why it needs to be done before December 31st, 2020. But what about company? Company is a little different because you could have company accounting on accrued basis. That just means that you could be paying and you could be writing a check on December 31st to donate $200,000, but that check is on accrued base, so it's become your expense, but it's payable to the nonprofit maybe on January the 3rd, right? So that's different. But on the personal side, it's always cash. It's always cash based. Okay. Next, before December 31st, 2020, the business owner need to think about renovations, property purchases. Okay. And reconsider if you didn't do renovation in 2020 because you are so stressed out with pandemic, like I am so busy with this pandemic stuff, I didn't finish writing my book, right? You might be just like me. You're supposed to do it, but you didn't do it. Then look at your 2019. Did you do that in 2019? And if you did that, there is something you can do in 2020 to correct what wasn't due right in 2019. And if you did that in 2018, you can consider cost segregation for the property to bring the depreciation adjustment into 2020 or even go back to 2019. So before December 31st, 2020, and we want you to think about how you can reduce your profit to the lowest. Not that we're trying to skim the government to not pay taxes. The government told you to take advantage of those tax rules. And if you don't, you are just one of those taxpayers love to pay tips to IRS. Nothing wrong with paying tips to IRS. And IRS survives on tips. But if you are not really meant to pay tips because you're still struggling with your own business, and why are you not utilizing those rules, right? So you want to make sure if you renovated any properties in 2020, every dollar you spent, it will be expense. So let's say you renovated 450,000 and you actually 2020 you are not doing that great, so you actually had maybe $10,000 profit. That 450,000 will drive you to have a $440,000 loss. Am I right? Because if I write off all my renovation, which I normally I don't, because someone told me that it is 37.5 years depreciation, and but now Ying said it's 100%. Okay, if I do that way, and I'm going to have $440,000 losses. You absolutely right. You do. And what happened to the loss? Remember earlier I told you that you can go back 5 years to look to see whether in one of those business years you actually paid taxes. If you did, you offset that gain and you get the tax dollar back. That's what CARES Act says. Why are you not taking advantage of? And if you are going to expand your business anyway, why are you not looking for property to purchase even before December 31st? If you see one that is right on, is what you like, buy it. Because when you bought it, even though you say, well, Ying, I did buy the property, but I didn't pay anything. I 100% finance it. So what? And that is still deductible. And so your building, let's say you spend $500,000 to buy the building, and the building structure depreciate 37.5. There's other things depreciate 7 years, 5 years. So you will get $200,000 on depreciation. So if you made a $10,000 profit, you have the $200,000 depreciation. So what's your loss? $190,000. If you made a profit in 2015, $190,000 profit, and you paid $45,000 taxes, that is what gonna come back to you. Congratulations, you just got $45,000 refund out of nowhere, out of the past, out of the places you would never get it back if it is not pandemic, if it is not CARES Act. So folks, that's why we're talking about before December 31st, 2020. After you finish this webinar, if you don't run and do something, I don't know why you are here. You should not be here. And after this webinar, I need you to run to get things done, because that's how we can do a good business. Next, before December 31st, 2020, there are people are not doing well. Okay, so run out of funding, PPP is gone, EIDL loan is gone, and just really, really want to reconsider life. So they want to sell, they want to close. Okay, and you close the business, you sell the business at loss. Do you know that that's a gold mine? And don't walk away without making a announcement with community CPA. We need to capture the loss for you, and we will go back 5 years to get those taxes back for you. There is nothing called loss in business. In business, there's only gain and the losses with certain time frame. But overall, you should make it. Overall, you should make money because of all these changes and all of these tax rules, all of these benefits that you're supposed to get. So, closing entity, even if you file bankruptcy, I know when people file bankruptcy, they're looking for relief. So the money they owe, they don't want to pay, they don't pay anymore, is written off. But if your bankruptcy wasn't finalized by December 31st, 2020, but you close your business by on that day, and you still entitled to the loss. But of course, if in 2022 you got a bankruptcy chapter waived and you owe $200,000, you no longer need to pay, is written off, then you should report income at that time. Because right now, without bankruptcy, we're taking that in as expense, right? So we got benefit for you already. So in the future, and you would pay that as income if you are forgiven. I mean, if you are written off through bankruptcy, discharged through bankruptcy. That's the word I was looking for. English is not my native language. So when I get desperate or when I get really tired, and sometimes Chinglish pops up, they're like mixed of Chinese and English, is really weird. And I create Chinese words and I also create English. Sometimes there's some famous things I created. It's become a household jokes at my house. So so forgive me if you see spelling errors and if you hear me talking nonsense, and you know why. But I think my knowledge is there, so you just look at the positive side, okay? So that's how why we become friends. Okay, the next one is heavy lifting. I know that. And oh, I wrote, see, spelling mistake. I meant to write clean up your balance sheet. I'm putting in learn up. Yeah, okay, learn up. That's a Chinglish, learn up your balance sheet. Learn up your balance sheet because I want you to go through these items I put on here. Let's talk about it. And I know for business owners, it makes so much sense about income statement, right? Income statement is we understand that, and we make money, we spend money, and we left over. But balance sheet is a little bit different. Balance sheet have this thing called bank balance. Okay, some business owner will come to me and says that, look, my financial statement is done wrong by this firm, and look, and it says that I made $500,000, and look at my bank only have $10,000 deposit. How could that be possible? It is not right. Absolutely making no sense. But it is possible, it is correct. That's why I want you to clean up your balance sheet. And if you have your bank at 10, but you have your profit at 500,000, I want you to look at accounting method that you are doing. Maybe you are doing income statement on cash method, but you are doing balance sheet on accrue method. That happens a lot. And so make sure that you are aware. I'm not going to drag you through accounting courses today, but I just want you to know there is a big difference between cash method or accrual method. And when you look at your accounting financial statement coming out of your CPA firm, and when you look at your tax return coming out of HR block, you want to make sure that they are using the same accounting method. Sometimes, so unfortunately, people are overpaying taxes because they were using different method, being inconsistent. Okay, so now receivable. What receivable means is you haven't even received it yet. It is already your income. And if you want, you write it down right there. If you have receivable on your balance sheet, that means you haven't even get the money yet. You already said that it is your income. That's not cool. If you are cash method, if you report taxes only on the money you received, then you should subtract receivable out of your sales. You hear me, right? You need to subtract receivable out of your sales if you are a cash method accounting. Now, loan to shareholders, very bad item on your balance sheet. If you see that under asset, you need to know. If you close the company tomorrow, let's say we company doesn't do well, we lost money, we closed it, right? But if you have a penny on loan to shareholder under asset, you pay taxes for that amount. It doesn't matter you close for loss or not. So that need to disappear. That need to be treated. That means your accountant believe that you are spending money, you are spending company money on your personal stuff. That's why it is not expenses. It is a loan you borrow from your company. Not very nice. Why are you spending your personal stuff on your on company dollar? That should not even happen. If I am a good business person, I don't use company money to spend my on my Starbucks coffee. And I don't $3. Come on, I don't even have time to count that way. But anyway, I don't. But if I see loan to shareholder, I am going to say that, hey, accountant, that doesn't make any sense because I don't use company money for my personal purposes. What you have in there? Then you can go through, clean them up. They are all your expenses. Okay? So That's why I'm telling you, I need to give you those hints before December 31st. Now, look at these liabilities. Unearned revenue. What does that mean? That means you received the money, but you didn't earn it. Example would be if you are a company who charges annual fee for service. So let's say if I tell you that, hey, I do your taxes, and if you pay me $5,000 in January, I will make sure that I do all of these services for you and file your taxes. Do I include the 5,000 in my income in January, or I should actually put that in my income when I finish the service? Of course, it's latter, right? So for some business, you have unearned revenue. If you have unearned revenue, that means this pot of dollars should not pay taxes yet. You didn't even earn it yet. You're not entitled to it. It is your liability. If you didn't do a good job, you have to return it to your clients. So with that, and then you may say, whoa, Ying, I have never thought about that. I'm telling you, I am a contractor. I charge $1 million for the project, but my first million, and I don't finish until next year, May. I only probably finished half of it. What does that mean? That means only 500,000 should be your 2020 income. Okay, so I want you to understand that concept. Next one, payables. What is payables? Whatever dollar you see there, that means you already put in the expense, but you didn't pay yet. And if you are a business owner, claim that never owe anybody money, do you supposed to see payables here? No. So clean up your balance sheet. But of course, if you see payables for $1 million and then you actually you actually didn't pay, but you are on cash accounting, that means that $1 million expenses that you included in your income statement, that should come out because you're cash accounting. You cannot deduct it unless you are accrual. And then of course you will deduct it because that's your method. Okay, so liability, so important. Okay, so that's really, really key. And I want you to remember that. And then PPP. PPP before November 18th. Before November 18th, I said to everybody that don't rush to apply for PPP because if you don't get forgiven, it is a loan. So we don't reduce your expense. You use PPP to do payroll, right? So your payroll is $200,000. PPP covered 50,000. And if you didn't get forgiven, you can deduct the 200,000 full payroll expense. But if you got forgiven, you need to reduce the 50,000. So you can only deduct 150. So therefore, you got more income, more taxable income. So PPP, but on November 18, there's a new IRS guidance come out, said that as long as your PPP will be forgiven, you know that it will be, and you spend it properly, and you should reduce your expense anyway. They should not be your liability. So what I'm telling you is before December 31st, 2020, you need to get your PPP cleaned out and you need to reduce your expense. And unless your PPP forgiveness is not a certain matter, you're not sure, maybe you won't because this, because of that. Otherwise, you need to reduce your expenses by the amount of PPP. Your balance sheet, the liability should not have the PPP amount in there. It should be zero. Okay, so that's that. And EIDL loan is a loan. And making sure that you don't use EIDL loan to expand, to buy building, to do stuff like that. EIDL loan is paying for working capital. What is working capital? Working capital is everything that related to your work. So to your working on daily basis. So that means salary, that means inventory, that means office supplies, that means auto vehicle, gasoline, repair, things like that. So make sure you don't use EID alone for capital improvement. Okay. Shareholder loan. Shareholder loan is different from loan to shareholder. That's why I put it in here. I want you to understand the difference. Loan to shareholder under asset means that you're spending company money for personal expenses. Your accountant got so angry, they say, no, I don't want you to deduct it. I'm going to make sure that you pay company back. So there you go. You got a loan to shareholder. But shareholder loan means you subsidize the business. So it's just like the money you have in the bank account. That is because you put it in and to have company to use it. So it's like your investment. Let's say if we sell your company today, and let's say shareholder loan is 200,000, and we sold company for 200,000, and that 200,000 is nothing but returning your loan from the company. So that 200,000 returning your loan, you take it back to your personal bank account, deposit on your personal name. When you file 1040, do you report that as a gain? No. That is to return the money you put in. The money you put in actually already paid taxes for. Don't you think so? Right? And where there's no way you're gonna have money in your bank account under your name you didn't pay taxes unless you're doing something wrong. Okay, so that is where we are. I care about shareholder loan because I want you to get the money back to your personal without paying additional taxes. Equities. Equity is so complex. I'll tell you that there's 4 items in equity and you need to know. Number 1, your shares value, right? Initially, when you just started business, maybe you put in 1,000. So there should be a common share value 1,000. Then additional paid in capital are the additional money you paid in. And sometimes people put shareholder loans into paid in capital. So it just says that it's not going to returning to you like that. You're going to take it back as a capital gain or loss when you sell the business. So there is a paid in capital. Then retained earning, that's a accumulation of your history. And then net income. Those are the 4 items. I will just say that you want to learn up or clean up your balance sheet. Makes sense, right? Those stuff I talked to you, and it will help you think of how you do taxes and how that impact your taxes. All right. And the one more item that related to before December 31st, 2020. And before December 31st, 2020, and I want you to think of the retirement withdrawal and a retirement contribution. And I want you to think of anything that you would spend and now then later. And I want you to think about all of your income that you booked as your income, whether any component of that you haven't even earned it yet. Okay? So these are the things. Consider all the expenses that you have to reduce your taxable income and consider your income statement. Right? So retirement contribution obviously is a non-taxable item. If you have a 401k, you can put in 19,500 out of your W2 is non-taxable, and the company can match 25%. So these are expenses, right? So think of the benefit that you would bring to the company and to the employees of the company. Then think about maybe before December 31st, you're in such a hardship. Instead of putting in more money, you want money out. And if you do that, fair square. And that's also have a tax benefit to it because in 2020, under CARES Act, it says that you can withdraw up to $100,000. And out of the $100,000, as long as a COVID-related withdrawal, for example, you got sick, kid got sick, and COVID-related, okay? And then no 10% penalty. Did you hear that? No 10% penalty. And one more thing, only 1/3 of the $100,000, only 1/3 of the amount you withdraw would pay taxes in 2020, the other 1/3 in 2021, then the last 1/3 in 2022. Benefit. All right. Okay. Now, I kind of covered all the things, important things a business owner would do before December 31st, 2020. Now, I want you to follow me to look into the future because I have a really important concept I need to tell you because a lot of people are not doing it. Okay, looking to the future and the way you are doing business is going to be different. Okay, you are already experienced that. You are having a restaurant, you already know that dining in it didn't work, so you're doing catering, right? So the way you're doing business is not going to be the same after pandemic. That is the thing I want to drill into your head. Don't tell me that, oh, I'm just gonna sit around, wait, not doing anything right now because the pandemic over, I will be booming. No, the business is not the same anymore. Human life is not the same anymore. Do you know that COVID is gonna stay forever? And then the only difference is that we are going to have vaccine, so you can get vaccinated so you don't get COVID again. But COVID is not going. And technology is not going away. It is getting more involved. It's gonna transform life. Okay. So I want to say that 2020 is forever altered how we do business tomorrow. Forever. And so technology will evolve, continue evolve, and the touchless concept, everything touchless. And that's a thing that is going forward. And even when we drive, now it's touchless driving, right? And it's not so much for sanitation concern, but people get lazy and easy. Touchless is a thing. I want to pay credit card. I don't want to touch anything. Can you just use my eyeballs and pay credit card? Yeah, it is coming. Okay, so having said that, and the service is different. Look at you. Today you are with me on webinar. And can you imagine you were with me this way last year? No way. No way. We do this. We only become this way because I get so frustrated. I don't have a way to see you anymore. And you are calling me, telling me that you got COVID, but you also need to do your accounting and taxes. And the only way I do it is to go through webinars and do Zoom meetings and stuff like that. So our service changed. And you don't see me, but you see me. And you don't talk to me, but you talk to me. And you don't hear me, but you listen to me. So things are changing. Okay. And online selling and door-to-door delivery become a thing. And I'm only giving you the future look because I want you to vision what your business is going to be because of that. And the personal service will have more regulations, and the business best practice is going to be social distancing and the cleanness. Even when you go to a barber shop to get your hair cut, you think after COVID-19 and the people will all take off their mask and be done? I will tell you, certain service will continue on face mask practice. It will be more. It will be more normal. And no longer a Republican doesn't have mask and the Democrats has mask. That's ridiculous. That's actually the biggest, the ridiculous things ever I see in my life. But it just played out in this country is amazing. Okay. But in business, we don't care about politics. Business owners are the rulers. Business owners will know what to do to please the public. And when the public come to us, they don't label themselves on the forehead, they're Republican or Democrat. And they may be Green parties, who knows, right? So they coming in, they care about their personal safety. And the mask, it's gonna be a norm thing. And there's a lot of practice are changing. So you need to do what? To prepare your business. Prepare. And don't think that pandemic gonna be over. It's not over. It will never be over. And the business changed forever. The only over thing is the fear. The fear will be over because of the vaccine. The pandemic is here to stay. It is here. And so practice will be different and you need to really think hard. So I want you to look at this. Sales volume in 2020. I want to break a thought that you have in your head because I know business owners and the business owners, a restaurant example, in 2019, they made $1.5 million sales in the year. 2018, they were making $1.4 million in the year. 2017, they were making $1.3 million a year. So they have been growing 100,000 a year, every year. So in 2020, the business owner wants to get 2 million, 1.6 million. That's what they're thinking. No, it didn't happen. Pandemic came, the dining in doesn't work, so they began to cater. And they only made $850,000 sales. But one truth, no one will say that to you, but you know it, I know it. The restaurant owners, even though the sales went down by that much, but no one really lose money because they don't have to pay that many workers and they have much less overhead. So even though they're doing catering, they make less sales. They probably made lower profit margin. But for restaurant to completely have a negative number, I will tell you, not many. Not many. The one who runs negative are also the one didn't do good anyway. Pandemic or not, they're not going to be there. Okay, so now 2020 is a 50% rules. I want you to remember that. I want to knock that into your head. And you know that whatever you make in 2020, and take 50% of that, that 50% is not the same clients that you have from 2019. So if pandemic is really over on January the 1st, 2021, you should make $1.5 million like you always make, plus the 50%. If you did renovation, if you planned it, and if you really had a future vision, you're supposed to get there. So now here, I want to tell you that if there's no pandemic, you should achieve 1.5 plus 425. So your goal for a year without pandemic fear. Pandemic gonna be here, fear is not gonna be here. And if that is the case, you should run 1.9 million. So folks, the 2020 is a year that for you to see clearly how much potential you have when there is no more pandemic fear. And so with that, you know what you need to do in 2021. So my word to you is that if you follow my thought here, you know what your sales gonna be. Aren't you scared? Aren't you feel like, oh man, I need to do something more. I need to do something more because I won't be able to take that much sales. It is too much for my little place. I need to redo something. So here, then I say investment. Today, you do capital investment, people investment, organizational structure readiness investment. Okay? And you really need to think about that. I'll tell you that I am thinking about it. And I always relate everything I say to you with my own business experience. So I'm not copying from somebody's journal and I'm not just telling you one of my clients' thing. I am telling you collectively all 10,000 clients that we have, plus my own personal experience. So today, this year, it is a year of investment. And when everybody's short of cash, maybe you do have. And use that 10%, use that cash you have, put in 10% investment and buy a building, expand, if you are going to expand your sales like what I'm projecting you to expand. Remember that 50% rule? Your 2020 sales, 50% of it is not related to your past. It is created now. So use that creation, don't lose it. Take that momentum, grow your business forward. So capital investment and renovating your building and buying a new building. And I'm looking for a building in Bloomington area because I want to expand Bloomington office because we're short of space. We couldn't even hire people because we don't have space, not because we don't have people. So things like that, and it is hindering the growth of the company. And we need to start doing that right now, not to wait when the pandemic fear is over. Okay, people investment. If you are in the business relying heavily on people, this is such a great time to get out to search for them. You don't even have to hire them, but you need to talk to them. You talk to them that, hey, we will have something open up, and pretty soon, as soon as the pandemic fear is gone, and we want you to consider us if you want. People investment, guys. Okay, so that is the smartest thing to do right now. And organizational structure readiness. I'll say this one is a real smart thing to do. During pandemic, everything is like new. And nobody have pre-existing idea of what should be. There's nothing should be anymore. Everything is up in the air. Whatever you do, whatever you say, right? In the organization, you may have what it was before. But pandemic give you an opportunity to shake yourself up. You can redo everything any way you want it. And in the past, community CPA, we used to have one person take care of one client. And so that client, even though we have 20 some people firm, but that client only know one person in the firm. And the pandemic come and it's not practical. We all working from home. And that client calls for that person, phone rings to their house, the person is busy with their kids and or walking their dog at the time. And there is nobody pick up the phone. So to cure that, and it's almost giving community CPA a brand new opportunity to restructure ourselves, make ourselves more perceptive to the change so we can grow better. So what we did is I learned from Mayo Clinic. I go to visit the Mayo Clinic doctors and I realized that when I go there, they give me a sheet and they call them care team. So on the sheet, it tells you who's your doctor, who are the team to take care of you, and it's so amazing. And I take that idea, come to community CPA, we established care teams. So we have accounting team, tax team, business consultation team, and we have, um, um, the other one, marketing team, right? So payroll team. So we have teams set up now, and with the team, we tell our client that here is our care team. You have payroll service, accounting service, tax service. So there's 3 leaders you have, and they all have team members that can work for you. So that is how organizational structure readiness means. And I'm not saying it because I don't know how to practice it. I am saying it because I already done it. And I knew it worked really well. Plus 10,000 other clients to prove that it's working. So why not you? Think it. And don't tell me that, oh, Ying, I have 2 people in my company. I don't need that. It's just me and me, or me and my spouse. Trust me, your spouse is the one needing the structure. And don't let your spouse run away from this. And if you need your spouse to do something and you know how hard to regulate them, this is such a good opportunity to tell your spouse that this world changed. Now I'm your boss and just listen up. And the order changed in business. As soon as you step into that door, you listen to me. So a good structure to get ready. All right. So this is investment into today. Allow growth to come. Growth, GROWTH. My Chinglish is at display, but anyway, um, you understand. So allow growth to come. And I know I'm running out of time, but I want to tell you that success, I always see success as a very timid little girl and coming to your door, knock, knock. And if you are too noisy inside, you're struggling with your business, struggling with your people, and you won't hear that little knock. She'll just go away. She go to your neighbor, knock, knock. Okay? You want to be ready. You want to hear that teeny sound, and then you grab the opportunity. Opportunity knocking your door, and you want to hear it. That's what I'm saying. So prepare for the opportunity. You must have cash on hand. I'm not saying you need to have a couple millions on hand. There are clients of mine do, but you don't have to be that one. You can have 10,000 in hand. You can have 100,000 in hand as long as it's a down payment of something, right? And prepare your bank relationship. When you see a building you want to buy, no time, you can buy it because you already prepared your lending relationship with your bank. Prepare for people relationship. And don't just talk to your friend and the Thanksgiving, happy Christmas, happy holidays. That's it. No. And tell them that always keep an eye out for you because you always need people. And prepare your friend, prepare your facility, prepare your equipment, and prepare and allow that opportunity to knock your door. Allow yourself to hear that. This is a resolution for 2021. Folks, when pandemic fear is gone, do you know it is all about growth? No question. No question. But how much do you grow? You have to get to the point I told you. Your past revenue plus 50% of 2020. If you didn't get there, you lost the little knock you're supposed to hear from that little girl called success. That's the message I want to give you today. Of course, I want to tell you that we provide consultation service. All of these things I'm talking to you, we can provide that service to you. And don't look elsewhere, look at Community CPA. And we are the firm, we want to grow. Our ambition is big because your ambition is big. And we don't care about big companies like Amazon. They will never be my client. And I'm not attracted to those kind of business. But I am so excited if you are like me and your life is going up, your business is upticking, and you just got held back a little bit by pandemic fear, but that is going away. And do you know that the doctors getting vaccine next Thursday? Doctors. Doctors at front line are getting vaccine next Thursday. So that's a good news. The herd immunity will come in, fear will be done. Of course, the fear not gonna be gone in overnight, but it will slowly. In 2021 is a recovering year. But 2021, folks, I want you to know you're supposed to get your sales, regular sales, plus 50% of 2020. All right, conclusion. And we always have Saturday 3 p.m. I'm running over time, but I appreciate you being here. And go into YouTube, like us, subscribe, and tell your friend that Community CPA does such a great webinar out there. Let them listen to us. You know what? The more people who are following us, the more energy we're going to gather. And in business is a lonely game. You're the business owner. You don't get a lot of people to talk about your business, okay? But you can talk about your business with us because we live your life. We were in your shoes, or we are in your shoes, or we will be in your shoes. So we will be there to support you, okay? And I will talk to you really soon. And it's so good to see you. Bye bye.